Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. UAE time, of course, much earlier where some of our speakers are joining us from, and we're very grateful for their time this morning. Let's kick off in the United States with Mike McGlone, Bloomberg Intelligence. Mike, have we seen the low of the oil price, of the Brent crude oil price this year? It happened last week after the big news, the crash touching down to nearly $60 on Brent. Is that the low for the year now in?
Unlikely. I think we're supposed to be looking for rallies to sell. Some of the key determinants are that have we seen the low in the U.S. stock market? That's unlikely. Bloomberg Intelligence says in the case of recession, it thinks the S&P 500 is going to go to about 4,000, and right now it's 5,300 approximately. Bloomberg Economics expects the potential we're going to get that recession. They have the whole world facing tariffs. And the thing is, we had excessive trends in excess supply and diminishing demand before Mr. Trump was elected, before these historic tariffs and the unprecedented tariffs and austerity kicked in the U.S. So my bias for crude oil remains quite bearish. I made the call way too early. I admit that. Nothing like you keep saying the same thing, eventually be right. I don't think crude oil really bottoms until it gets below the U.S. cost of production, which is around $50 a barrel now, according to Bloomberg New Energy Finance, and gets down around $40 a barrel. It's not profound to say that. It's been doing it for the last 20 years. Once it gets above 100, it gets below 40. But the key things I'm watching in all commodities, looks like copper's peaked. Copper had a odd reason to make a new high. It did. It's looked like it's peaked around 537. I think it's heading towards 3. Looks like U.S. natural gas. Every time it gets above 4, it usually drops to around 2. It looks like it's doing that. You look at the rest of the grains, which are major competition in this country for biofuels. Unless we get a drought in this country, they're heading lower. And there's only one major commodity that's going up. It's gold. And that's getting a little stretched. So the bottom line, the elephant in the room is the U.S. stock market for all risk assets, and particularly for deflation to transition from the inflation, which is usually the scale in the world, and that's U.S. stock market. So I'm still quite bearish risk assets and still bullish gold. And I think the next key thing will be, I'll end with this. Look at the deflationary forces in China. You can look at their 10-year note yield at 165 this morning. It reminds me of JGBs in the 90s when I traded those. And I think the U.S. bond yields are going to eventually head that way as the Fed eases as we head into this recession.
Ahmed Mehdi, Managing Director of Renaissance Energy Advisors and Senior Fellow at the Oxford Institute of Energy Studies. Ahmed, welcome back. Lovely to see you again. I wanted to get your thoughts on the sort of immediate news of where is this China-US face-off going? Seems to be ever so subtly creeping in of a resolution or some kind of possibility. Where is all this playing out? How is it going to impact demand, do you think?
Yeah, thanks very much, Sean. Good to see you again, and nice to see you both, James and Mike. Yeah, I mean, just in terms of the demand story, I think this is all still playing out. We've seen tit for tat escalation. In terms of the crude oil market. I mean, naturally, when we're looking at this, we've seen revisions to global demand. We've seen global GDP forecast being revised. I think in terms of actually just maybe separating a little bit from what's happening with flat price versus what's happening with the physical market, I think the most immediate impact so far has been on liquids demand when we're looking at petrochemical feedstocks, and so far we're seeing some of that impact in terms of the US trade flows, particularly of LPG into China, and that's leading to some revisions. And already in China, we're starting to see run rates for some of the petrochemical plants beginning to become lower because already margins were under pressure before the trade war. So we're starting to see what was meant to be one of the biggest sources of demand, which was basically LPG and ethane, leading the Chinese move to more towards naphtha. So actually, before the trade war, the only really big demand driver in China was going to be the petrochemical feedstocks. Now, it's not going to be LPG, it's not going to be ethane, so it's naphtha. Gasoline has basically flatlined. Diesel is more of a cyclical issue rather than a structural thing in China. So actually, probably you're looking at relatively flat demand growth in China. And that's even before we start to see the indirect effects of tariffs. It's too early to say what that's going to look like, but at the moment already in terms of the financial markets and its relationship to crude, as you know, I don't share completely the bearish sentiments of Mike, but certainly that's already beginning to play in terms of macro expectations. So long story short, I think it's complicated the position of the Fed, but a very important point to say, it's still actually the physical market is still holding up relatively well. We're still seeing physical premiums in the Middle East Asia market, and actually across the barrel already there was a bit of a petrochemical oversupply anyway. So it's leading to revised views, but I don't think we're going to be. It's still too early to say exactly, what the full picture looks like, because this is a moving picture, and also it's a game of chicken as well. So we have to wait and see exactly what the retaliatory effects are going to look like.
James McCallum, CEO and Chairman of Exergy Group and Professor of Energy at Strathclyde University. James, on the other side of that, obviously there's the supply side. Mike starting us off, giving a sense that we're not at the low price for the year. Ahmed indicating, still some life in that old dog demand. So at the moment, but on supply side, what did this price level, whether we're at the low of the year, we've seen the low, we're sort of deep in the 60s here. What do you think that looks like for the industry, for the investment into the upstream, new capacity, new development?
Oh, gosh, I thought you were going to come to me and as a 65-year-old Scotsman, Sean, and say, look, sad as this might seem, James, I'm turning to you for a degree of optimism in the story this morning.
Will the oil price be higher than your age or below your age? That's the question here this morning.
Well, that's a great question, because, of course, I'm absolutely at the point where everybody predicts it probably is going to be, which is $65 a barrel. So look, the reality is there's a storyline which reflects exactly what you're leaning into on the Press Digest today from the CEO of Liberty Energy, whose company value has dropped by 43% this year so far. Look, Sean, we talk about this regularly. I want to get away from the trend that is downwards in terms of the oilfield services sector and if you like, the non-OPEC producers, but it's extremely hard to do that. If you take a look at the major producers, Shell, BP, Chevron, certainly if you look at the last month, no surprise there, they're all down somewhere between 10 and 20%, the producers. If you take a look at it on the year, they're down, 17% Shell, 32% BP, 15% Chevron. So this is a continuing trend. If you look at the service companies, it's even worse than that. If you look at Schlumberger, they're down 33% in the last year. If you look at Halliburton, they're down 44%. So the Liberty Energy CEO's story is not out of kilter with everybody else, and that's because activity, particularly in the US, has been falling in terms of rig activity. I've touched on this every podcast I come on. Baker Hughes rig index down now about 300 from nearly 1,200 rigs in 2014. So we're on a declining story in terms of investment into that space. And to be honest, the one thing which every speaker has reflected on this week is that we are certainly not in a place where anybody feels a high degree of certainty. So I think the continuing trend is in that space is down.
Mike, just picking on that, I mean, if we have a sense of where demand is at, and we saw earlier this week the forecast, the OPEC starting to revise downward, although sort of very minimally, but nonetheless, the trend for them will clearly be every month a revision downward. IEA took the big leap and went way down, already half of what OPEC Plus is, but everybody seems to be now down in the 500 to 700,000 barrel a day growth in demand, maybe even lower. The question is, where is supply? Could we see U.S. oil production this year actually decline, given the price point, given the demand outlook?
There's been the number one force for one of the most significant trends in commodities the last 20 years has been that increasing U.S. production of crude oil and liquid fuels and decreasing consumption. That spread, which is now a major, pretty much surplus now. U.S. has to export with Canada over 6 million barrels a day just to break even. That's been one of the most enduring trends in commodities for 20 years. And the number one force to make that trend of increasing production versus decreasing demand blip was when prices go down. You see the trajectory there. And it's also what Ahmed said is about global GDP forecast. The revisions are all downward. What stops that trend is the key thing I like to point out. So it's an overwhelming force right now. It's the classic thing that happens in commodities. I learned from the grain traders, the low price cure. We have to get to the low price cure. Remember the cycles. The cycles always work in commodities on the back of we spike too high, and when Russian invasion of Ukraine from 150, 130, and now we're just heading down to that low price cure. Where is it? But now it's small macroeconomics. So I think the wrong thing to do is look for bottoms in a bear market. Falling knife factor is to look for rallies to sell, and then look for the macroeconomic situation to change. And it's only getting worse. With these tariffs haven't even started yet. This stuff has been, if you read the book No Trade is Free by Robert Lighthizer, Trump and some of people like me have been waiting for this for decades. So now it's a great experiment in the U.S. The key thing, that's the overall trajectory for crude oil prices, for most commodity prices, with the exception of gold. The key unique thing about what's happening here is it is what it is, but we have a pretty significant self-correcting mechanism in this country if it doesn't work. If it doesn't work out by midterms, Trump will lose a lot of votes, and by the end of his term, it'll be over forever. But if it does work out, it's going to shape the world for 100 years, and that is just the exorbitant privilege of being exported with the U.S. And that's basically shifting. It's a post-World War II shift right here. It's the thing that's significant for me is it's coming at a time where the U.S. stock market versus GDP is 100 years. It's the highest in 100 years, and the U.S. stock market versus the rest of the world is the highest in almost 100 years. So we're just tweaking that tilt towards deflation. Commodities are leading the way. And I don't see what stops it at the moment. I think as a trader, be more tactical. And then one thing that's happened usually when you get risk assets this expensive, it's human nature to be quite surprised when we have normal mean reversion. And that's all we're doing in equities right now, a little bit of normal mean reversion. And that's what we're doing in most commodities. They always go to the break-even costs. There's a question how you define that break-even cost. I'm defining it close to $50 a barrel in this country.
Ahmed, looking at where OPEC is going, I mean, the trends as articulated there by Mike, the OPEC Plus seems to be kind of flying in the face of that with their current policy of increasing supply a little bit this month in April, a lot more next month. Where do you think they go from here? What's the logic, do you think, in their thinking going against what appears to be the market requirements?
Yeah, so just before going into OPEC Plus, I think
Please.
Just to go back, what was going on before the sort of opening salvo on trade wars. So, I mean, the actual demand in January, February, the basic Q1 demand was actually picking up. I think U.S. shale, or at least non-OPEC, U.S. shale crude supply growth was actually slowing. I think that's been a trend from the second half of last year and into the beginning of this year. But I'm not going to go into necessarily the motivations behind OPEC Plus compressing 3 increments into 1, but it's also important to look at, most of these, the laggards, if you want to call them, or the oversuppliers within the group, it was pretty significant in February and March. So Kazakhstan, Iraq, even UAE. And I think that, but what's really interesting is how divergent the supply numbers are in terms of getting a hold on actual OPEC plus supply. They're kind of all over the place for Iraq, UAE. The only country where I think most people agree that there's been, because of the Chevron expansion, is in Kazakhstan. So that's 300, 400 over. Iraq, I think, is certainly over. So most of these countries have already been in an oversupply mode. So when we're talking about the OPEC plus increase, is it actually going to be 400? No, it's
Well,
not.
you're getting quite into the weeds there of where the date. Let's just stick with the policy. They've
Yeah.
announced a tripling of increase of supply months in the face of a clearly global economic downgrade on growth.
Yeah.
The logic, is there logic? I mean, in order to sort of have some sense of where they may go, one must have some sense of why they started this pathway.
Yeah, so I think the audience for who this was targeted at was obviously the compliance cheats. Naturally, this has been something that's been talked about within OPEC Plus for a few weeks. I mean, the timing is obviously interesting. A sort of geopolitical alignment with the US is important. Now, in terms of why, I think this is really to try and tighten discipline within the group, and
not outside the group, not like
I don't
US
think
shale
this is aimed.
kicking the shins.
This is not aimed at US shale because, as I said, US shale was already slowing before this announcement, and also if you actually look at what the actual increase will actually look like, it's not going to be as large as what has been announced. So because most of that has already been there. And actually, if you actually look at what OPEC cares about, they care about backwardation in the market. And actually, that's still there. That's still in play. We're not dealing with a 2020 supply shock where it's about shocking the market and market share. It's not about that. This is about trying to tighten discipline. And as I said, what the key indicators they're looking at so far, we've still got the relatively healthy physical premiums. There's still a relatively low situation with the crude stocks, and actually in the products market, it's still relatively but as Mike said, it's still early days. The tariffs haven't yet come into play, and they can reverse course. So these are all important factors, I think.
James, I wanted to call upon your experience as a serial entrepreneur. You're building your fourth or fifth business at the moment, out there in the world seeking capital, etc., and aligned with but not specific to the energy industry. You're building a technology platform. My question really is, how has all of this sort of Trump 2.0, tariff, trade war, talk of recession, all of this sort of uncertainty, which is sort of the enemy of everything, impacting business leaders like yourself, looking to grow business, looking to access capital and so on? How do you think it's early foothills and some of the impact of this tariff trade war, but I'd like to get your sense of where things are, where they're going, do you think?
Okay, good. A lot of questions in there, Sean, which I'll be delighted to answer. But I do want to come back, if I can, just for a second on
Please.
Some of the comments that Ahmed made there, because I don't think this OPEC move is entirely down to, if you like, a discipline. I think it's a major part of it, but I also happen to think that there is a conversation where some of the OPEC producers, particularly the ones that have residual capacity to produce extensive amounts of oil going forward, and by that you can look to Saudi, the United Arab Emirates. They are smelling blood in the water, Sean. There is no doubt about that. The difference between the US basins now as to where they were at the start is that OPEC got the potential for US production very badly wrong at the beginning of the development of the Permian basin. Now, where we are now is that the Permian Basin is a mature basin. And as a mature basin, it is much, much easier to predict when you will see peak in terms of production. Now, prior to the current circumstance, there was a lot of talk that the peak would come in anyway in late 26 or 27, around about 14 million barrels a level. per day. But the reality is that what we are seeing in terms of the declining rig index, in terms of the US major oil producers' stock prices, in terms of giving back finances in dividends to their shareholders rather than investing in new drilling, the reality here is there is an opportunity again to hold the price at a level which is very unattractive for US international oil companies to drill. And that's why you're seeing falling activity in terms of number of rigs. That's why you're seeing huge drops in the share prices of the service companies that operate in that basin. So I just wanted to come back to that point. For me, it's not all about just producer discipline within OPEC. There is also a sense that they are smelling blood in the water of the US producing capability. Coming back to your question that you asked me, you know, the interesting thing about markets like this, especially if you're in the tech space, I've talked about the oilfield services, so I'm not going to go there, which is where I was before, is that increasingly companies are focusing in on how they become the best version of themselves that they can be. How do they focus on margin optimization, profit optimization based on where they have been in the past? And the only way to do that in a world where access to talent in the form of human intellectual capital has its own inherent restriction is to be better at what you do. And to be better at what you do, the real potential in that space comes through digitization of one's business, access to the data pertaining to your business, and the use of artificial intelligence to analyze your internal data and put it into more efficient processes. So capital continues to be difficult to access if you're in traditional industry just now, because nobody feels any kind of certainty. But what we are seeing is that certainly in terms of private equity, venture capital markets, they are really looking up now to see where is the area that they can invest in and get ahead of this thing in terms of margin optimization, profit optimization. And that space is tech. Now, not big tech like Apple or NVIDIA or whatever. And Mike, I'm sure, will talk very knowledgeably about, you know, the continuing position of that in the stock markets, but new tech, you know, as new tech is emerging that plays into that efficiency and effectiveness agenda, it's proving very, very attractive for the private equity and venture capital markets.
Let's go to the survey question, which is sort of the original question this morning. Have we already seen the 2025 low for Brent crude oil price, which last week hit a 4-year low, not quite at 60, but it closed above 61 something, I think it was around there. Have we seen the low for 25? Yes or no is the call here. We've seen in recent days and today the same, Brent crude oil and oil prices edging upwards. We're up at 1% today, you know, closer to 70 now than 60. Your thoughts, Mike, on that point? I mean, the tightening in the market, China still has a demand heartbeat. If China and the US start to look at sitting down at a table together, we could get a pop to 70. Your thoughts on this upward move now this week after last week's clear 4-year low?
Sharpest rallies come in bull and bear markets. That's probably happening in all markets, most notably the U.S. stock market. Crude oil is in, and we know this. We know this. There's an excess of supply that's growing and decreasing demand, and there's hopium that China will come out of this. But they are a massive deflationary exporter right now, including technology, as James mentioned. Crude oil is becoming replaced by technology, certainly in this country. So overall, the trend is bearish globally. I think good luck to China. I mean, I remember I seen happen this in Japan, and they weren't an adversary to the U.S. They weren't the decisive enabler of a war in Europe, as NATO described China. So they're in a bad place for just normal reversion of a rapidly expanding emerging market that's been shut off by its major customers, and who are all heading towards recession. Let's just look at Germany. Germany exports 50% of their GDP. China, Japan, China and Japan are closer to 20-25%. And those three countries, on average, their 10-year note yields are below 2%. So the key thing I think to think about is last week I was at the Farm, Food, and Fuel Conference, Bloomberg Conference in Indianapolis, Indiana. And we have a big problem in this country with prices of grains are declining. Unless we have a drought that continue lower, we need to find sources of demand, yet those are declining because of exports, because China's finding exports from Brazil, getting all the soybeans they want from Brazil because of massive excess of supply in the back of technology. And so the main source is biofuels. So that's my point, is in this country, we use 1/3 of our almost 12-15% of gasoline is now unleaded gas. The demand is declining. We're using EVs, and we need to find more biofuels to keep grain prices supported. So to me, you see the trend there? It's just a normal example of superabundance. It's a wonderful thing for consumers. It's the fact that we create too much with less, but we're in that downward trajectory right now. And I think it's it's not, instead of looking for bottoms, we should be looking for riding the trend, selling rallies, and where does it stop? But typically, I'll end with this. Typically, when commodities get expensive like they did, they used to rotate to get too cheap. The thing is, as James mentioned, we're hitting a technology revolution where we're, the world's largest demand pull source for not only goods and energy has an excess supply that's growing every day. So it's a great thing. But here also, the key thing is to remember is it's the stated goal of the Trump administration for lower energy prices, lower bond yields, and to try to balance the budget. And they're heading that way.
Ahmed, I wanted to get your insights. You're one of the greatest analysts on Iraq. Where is Iraq going? It seems to be, it's recently announced a 7 million barrel a day production target. We've got the UAE talking about 5 going to 6 now. But on Iraq, which has been a little bit of an outlier, hasn't always been conforming with OPEC plus quotas. Its elevated target, its willingness to conform with OPEC quotas, and then what does that say to the ability of OPEC Plus to hold together when all of these big producers want to make more oil?
Yeah, it's a very complicated situation in the country because I think the first thing to say is that it's an election year this year in Iraq, and that's quite important. And actually, part of the challenges in that economy has always been the outweighted size of public salaries and pensions as a percentage of the budget, and they have revised down a little bit, but there's always been flexibility on what their oil price forecast has been. At the moment, I don't expect there to be a reopening of the pipeline through to Ceyhan, despite the sort of efforts that have been discussed. Nevertheless, what is interesting is that the competition in the oil field service sector has brought down some of the upstream servicing costs. So there is actually quite a bit of upstream ambition to expand upstream ambition, and also TotalEnergies are sort of moving ahead with their mega project in the south. So upstream, it's actually looking pretty healthy. The problem is still there are bottlenecks on the midstream and export infrastructure. So where we are today with the current production levels of about 4.2 million barrels a day, that's expected to stay in line. The issue is, I think, is compensation mechanisms. And by the way, we haven't even talked about the UAE, which, the range of views of UAE overproduction are also quite significant. The compensation mechanisms are unlikely to actually take root. So, but overall, I do think that Iraq is important to watch for political stability this year, because you've also got the situation between the US and Iran. And Iraq is always a casualty of flaring tensions between the US and Iran. And also you've got elections. And I think if you start to see more fiscal pressures on the budget, then you will start to see cuts to salaries and pensions, and that always means protests. So I think, it's a complicated country which isn't always in the headlines, but I do think that the stability factor is an important thing to watch in the second half of the year.
James, just to follow on from your earlier comment, is the Fed situation. Fed Chair Powell was out yesterday giving sort of starker warnings about the potential economic consequences of the tariff war. And ultimately, it seems it's going to, with the inflation threat, keep the price of money elevated for longer. How does that additionally play into the economic outlook, the growth, business growth story, access to capital, optimism to take a leap into new ideas and so forth, build new businesses, hire new people? Where do you think all of those things are impacted by price of money higher for longer?
Look, the price of money higher for longer obviously builds in caution, Sean. So you have to be looking at where you're likely investing into a sector which has long-term growth potential. I said it earlier, and Mike, supported the view that tech is the space that is going to be a continual growth market going forward. But there is no doubt that people have to be discerning in that space. And on that note, it's worth me just saying that in the space of smaller companies, the risk of failure of that company in terms of its size is probably the highest levels that exist for investing into any business sector. Look, I think the bit that I just wanted to finish on, Sean, is and picking up on the point there that Ahmed made about pricing into big Middle Eastern projects, being very, very competitive due to competition between the sort of service suppliers. There's a very small line that exists between competition and desperation in terms of what the big service companies are doing in terms of pricing into projects. But the bit that is significant is that where the investments are occurring is into the Middle East. For me, what I'm observing here in terms of the moves that have been taken by the United States and Donald Trump is be careful what you wish for, Sean. We had a situation in the past where the United States, particularly in terms of the energy sector, moved away from the Middle East production reliability that it had, particularly onto Saudi, moving back, as it should have done, into a very strong domestic producing environment. And that has been hugely successful for the United States economy, hugely successful for United States companies. What we're witnessing now is a swing back towards where the Middle East is the center for future hydrocarbon production and long-term future hydrocarbon production, because it is a game of the last man standing is the low-cost producer. And that's why countries like Saudi and the United Arab Emirates have an innate ability to increase production when they wish to do that. And as a consequence of that, what's happening now is that they are continuing their move towards looking to alternative sources of supply, particularly into Asia, particularly in the area of LPG, which Ahmed, I think, touched on early on in the conversation. So relationships are changing across the globe with who you supply to, who you buy from, who you trade with. And so, we have a ways to go yet, but as far as what's going on in the markets right now as a consequence of Donald Trump's tariff actions, be careful what you wish for.
Be careful what you wish for. You just might get it. We have the survey just by a squeak saying no, we haven't seen the low of this year. It's still out there, as Mike says, but there is clearly an upward draft on the price this week, and maybe that is just the relief rally after the sort of near-death experience last week. Every week has its own reasons, it seems. Let's leave it there. James McCallum, thank you so much. Great to have you as always. Mike McGlone in the US, thank you, sir. And Ahmed Mehdi in the UK, great to have your insights today. Brent crude oil up 1%, trading 66.46. All the best. Have a great weekend as the days pass. Cheers.
Thank you.
Sean.
Thanks, guys.
Bye.